Good morning. Welcome to Edwin Coe's post-autumn budget seminar. We're going to be looking at what this means for private clients and their advisors, in particular in relation to the non-dom context. I'm Sean Bannister, Head of Tax at Edwin Coe. I'm joined by my colleague, Hetal Sangvi, who's also a partner in the tax group, and Lauren Mardell from our private client team. Before we go into the content, for those who don't know Edwin Coe, we are a central London all-service law firm. We're about 190 people, depending on the day, and we work across legal and tax services across a wide range of practice areas, but in particular, focusing on private capital. Our typical clients include wealthy individuals, family offices, private banks, trustees, and private and public businesses. Edwin Coe is a member of the Alla Law Group, which is a group of 80 independent law firms across the globe, and so we are well placed to service international clients. We've recently also become a B Corp, and we're accredited just over 6 months ago. So let's move on to the budget headlines and where we are as of today. So we're going to be focusing on the position for private clients. The major change, and the one that was much muted, was a change in the main rate of capital gains tax. We saw an increase to 24%, which brought that in line with the rates that were applicable to residential property. That change was a cliff edge change on the 30th of October, and so caught some of us by surprise. We were expecting something perhaps on the 6th of April 2025 or further down the line. It is, though, still a competitive rate of capital gains tax when compared to many other jurisdictions in the G7, and also is much less than some of the mooted changes, which were looking at potentially 30 plus or 40% changes, or bringing in line simply to the rates that are applicable to income tax. So overall, for most clients, not too much of a negative. One of the other changes that we've seen and will be introduced from 6 April 2026, April 27, is the change to inheritance tax and pensions. Previously, inheritance tax were broadly exempt, pensions were broadly exempt from inheritance tax. That will change from 2027, where those pension funds will be brought in. There is a consultation process ongoing to deal with some of the specifics in relation to defined benefit schemes, etc. And so do watch this space, but there will be quite a lot of planning required for clients that are looking at that previously looked to their pensions as an IHT mitigation vehicle, and what can now be done. In addition, we saw changes to the taxation of carried interest. The rate of tax applicable to carry now is 32%. This represents the first change in a number of changes that will be happening in relation to the taxation of carried interest for the coming years, in particular the introduction of national insurance contributions in that area. And lastly, in the area that we're going to be talking about for the majority of this seminar, is the abolition of non-dom status for the majority of tax purposes. Some caveats before we jump into the seminar. As some of you or most of you will be aware, we've only had draft legislation issued, so please take everything we say with a pinch of salt. We don't expect many material changes to the draft legislation as currently published, but do know that it hasn't yet received royal assent. The timing of a typical finance bill is late February for that to pass through Parliament. And so that leaves clients in the rather invidious, although typical, position of having to think about their tax planning on the basis of draft legislation. So I'm going to pass you over to my colleague, Hetal Sangvi, who's going to talk you through the new regime applicable to foreign income and gains.
Thank you, Sean. Good morning, everyone, and thank you so much for joining us. So I think there's been a lot of doom and gloom as it is associated with non-doms and the budget. But I think it's important to take a moment to really identify and understand what the good news is with respect to this new regime that is going to be introduced from 6th of April 25. And that is with respect to foreign income and gains for a 4-year period. Now, what do I mean by this? Essentially, those individuals who will be classified as qualifying new residents, so QNRs, they will be able to benefit for the first 4 years of tax residency, and this is after a period of 10 consecutive years of non-residency, of no tax in the UK on foreign income and gains, subject to some exclusions, which I will come back to. And the real sort of win here is that these foreign income and gains will be freely repatriable and transferable to the UK. So that's a real shift from what was previously possible under the remittance basis regime. Now, whilst this does negate the requirement for significant pre-arrival planning as it relates to the concept of clean capital, what I think it does do is move the onus onto individuals to be really proactive about managing their tax residency in the UK. So I think there's going to be a lot more sort of mindfulness around the statutory residence test, and where possible, really pushing back the date from which an individual triggers tax residency in the UK. The reason for this is that once you have your first year of tax residency in the UK, it's only those 4 consecutive years that this regime is available. So even if you have 1 year of tax residency and subsequently become non-resident, you do not have access to the regime for the following 3 years after that year of non-residency. Will only be the sort of 2 years after that. So it's always 4 years from that first year, whether you use it or not. So that's a real sort of blow where it comes to access to this regime, and I think particularly difficult if someone triggers tax residency inadvertently. So in terms of this regime and how it will operate, again, some significant sort of variation to what was understood to be the position under the remittance basis. So there will be a separate claim for foreign income and gains, and foreign employment income, but I'll come back to that when thinking about overseas workday relief. In terms of the foreign income and foreign gains, it will be a claim per itemised sort of each gain and each source of income. And this is really quite a significant compliance burden on individuals. And from this perspective, the allowances will be lost, so personal allowance, annual exempt amount, and also foreign losses will be lost. So I think it will require some planning and consideration rather than a sort of blanket exemption. One will need to be mindful of where they will want to benefit from this per foreign income or foreign gain claim. In terms of quantifying this is a significant burden as well, because previously this was not required. And there will be some consideration given, I suspect, to whether or not individuals will be required to recompute foreign income gains for the purposes of UK taxation. There's nothing to suggest currently that that won't be required, but this is something to navigate for clients. In terms of how one accesses it, it's quite interesting that actually there is no annual charge in order to access this regime. So this does make us slightly more competitive, even in comparison to some of our European competitors, when it comes to those new arrivals looking to come to the UK. I mentioned before that from a foreign employment income perspective, this will also be a separate claim. Now, the foreign employment income claim essentially replaces overseas workday relief, and this is where an individual in their first 3 years of residency was able to essentially distinguish between foreign employment income that related to overseas duties versus UK duties, and the proportion that related to UK duties was immediately taxable, whereas that in relation to foreign duties was only taxable if remitted to the UK. Now, similarly, and from a headline perspective, it was considered to be more attractive because essentially will align with the QNR 4-year regime for the equivalent of overseas workday relief. So it will be available for 4 years as opposed to 3 years. However, the significant blow here is that there will be a cap on the amount that can be claimed, being the lower of 30% of the total employment income or £300,000. And I suspect this will impact some clients quite significantly. One small point as well to consider is that business investment relief has been removed, will be abolished. I think this was quite a difficult exemption to access in practice for many clients, but in certain circumstances quite attractive. So this is where individuals were able to invest into UK businesses or loan funds into UK businesses and not trigger a taxable remittance. In terms of the exclusions, as you'll see on the slide, the first two exclusions, so the first one relating to foreign gains on the disposal of interest in property-rich companies, this is very much where the property-rich company attains its value from UK land and property, and this is not a surprise because this has always been within the scope. With chargeable rent gains, similarly, currently this regime sits outside of the remittance basis, and these gains are chargeable. And so these two exclusions we're not sort of too surprised by, but the one that is surprising is with relation to performance income. So this is any income received in connection with performances anywhere in the world. And I think this is quite unattractive because, again, it's isolating a sort of group of individuals who potentially could have seen the UK as quite attractive as a place to base themselves. That being the case, the opportunities that really do arise from this regime, I think it's going to be really interesting for individuals who want to plan around liquidity events, around any significant restructuring. For those individuals that are UK domiciled or formerly domiciled in the UK. And I think where it will be very good as well is with respect to distributions from trusts. Now, Sean is going to dive into trusts and how they're impacted in more detail, but in the context specifically for qualifying new residents, settlors of settlor interested trusts who have been sort of impacted by trust protections being lost will see that foreign income and gains are going to be attributed. However, if they are a qualifying new resident, this will not be the case as long as it's foreign income and foreign gains. That being the case, though, it is subject to a claim being made on the return. Equally, beneficiaries that qualify as new residents will also not be taxable on income distributions, but with capital distributions, there is going to be some complexities to navigate based on the matching of that capital distribution. So something to really look into in a bit more detail.
Thank you. Okay. We're now going to move across to Lara, who's going to explain some of the IHT changes for individuals arriving in the UK.
Okay, thank you, Sean. So when I talk about inheritance tax changes for individuals arriving in the UK, essentially I'm talking about individuals who have never lived in the UK or have been non-UK resident for over 10 tax years as a minimum. And for these individuals, the connecting factor is now UK tax residents and not domicile. So it aligns with the new FIG regime in that respect. And this can potentially be, as Hettel was saying, good news for UK domiciliaries because they can have certain benefits that they never used to have. Now, for the first 10 tax years of residence, an individual's UK assets only will be within scope of inheritance tax. Any assets outside the UK, with a few very limited exemptions in relation to things like residential property, but offshore assets will be outside the scope of inheritance tax. Now, when the individual has been UK resident for 10 years out of the last 20 tax years, they will become what's called a long-term resident, or LTR, and they will be subject to inheritance tax on their worldwide assets. Now, individuals under 20 will be called long-term residents if they are UK resident for half the years since their birth, which gives rise to some interesting little quirks for small children, but probably rarely relevant. And again, as with the FIG regime, people need to be careful about split years or treaty residents outside the UK because such a year still counts as a year towards the 10-year total for these purposes. So that was individuals arriving in the UK. And what about individuals leaving the UK? Individuals who have been UK residents for their whole lives or for at least 10 years. Now, when they break UK residence, they are not immediately back into the non-inheritance tax regime. They have a tail for inheritance tax purposes, and the length of that tail depends on how many years they have been UK resident over the 10. So individuals who have been UK resident for between 10 and 13 years have a 3-year tax tail, and then there is one additional year of tail for each year of residence, up to a maximum of 10 tax years. So the maximum tail is now 10 tax years. Now, this is actually quite a significant improvement on what we thought the position was going to be. The initial announcement was that once individuals had been UK resident for 10 years, if they left, they would have a 10-year tax tail, even if they'd only been UK resident for 10 years and 1 day. So this is an improvement on that, because we don't have that cliff edge. Then if an individual is non-UK resident for 10 full consecutive tax years and return to the UK, they're back into the inheritance tax beneficial regime again, and they have access to the FIG regime, as Hetty was saying. So to some extent, the inheritance tax and the FIG regimes align. So now for a bit of light relief, we are now going to look at the case of returning Brits who are in an unexpectedly good position now, by comparison, well, with effect from the 6th of April next year, compared to the position they are in now and they have been in up to this date. We have an individual called Alex returning to the UK after 12 years of working in Hong Kong. So he's considering returning after the 6th of April next year. So what rules will apply to him? Well, as you're probably all aware by now, he will be eligible for the FIG regime for 4 years. And he will only be subject to inheritance tax on his UK assets for 10 years. After 10 years, then his worldwide assets. So what can he do to take advantage of this? Well, there are a number of investment strategies that he can pursue, really involving maximising this 4-year FIG window that he has. He has that 4 years to trigger any offshore gains without giving rise to capital gains tax. He can use that 4-year period to boost his offshore income and build it up, and any of this can be brought to the UK at any time, either in that 4-year period or afterwards, without giving rise to any UK tax. He will, of course, need to consider taxation in the country where he was before, or the country where the investments are, but in terms of UK tax, he's got this 4-year tax-free period. He will have to watch out for the exemptions to the FIG regime that Hetty was talking about, most importantly with respect to offshore life insurance policies and investment bonds, which are subject to chargeable event gains. If he had a home in Hong Kong, he might want to consider retaining it in case he wants to go back, and that can be quite a tax-effective thing to do. He can rent it out. He will be exempt from UK tax on the rent. He'll probably pay Hong Kong tax on the rent, but that's a lot less. And provided he sells it within the 4-year FIG window, he won't be subject to capital gains tax on that sale. So that's income and gains. Just thinking very quickly about inheritance tax planning. Well, there is inheritance tax planning that Alex can do. Essentially, you'd be focusing on what we currently do for UK domiciliaries. So that's things like gifting, nil rate band trusts, normal expenditure out of income exemption, possibly using that to fund a life insurance policy wrapper held in trust, that sort of thing. So now I will hand back.
Thank you, Lara. So in terms of those non-domiciliaries who can't benefit from the new regime for new arrivals, so that 4-year period, and they're past that, they are hit quite hard. And I think it's safe to say there is some transitional relief, and this is principally in the form of the temporary repatriation facility. So I've titled this "Taking the Edge Off." So these are some elements of relief that I think actually, when looking at in a bit more detail, will be quite useful for planning purposes. So from a sort of just an understanding perspective, who can access the TRF? Essentially, it is any previous remittance basis users who have at least 1 year before 6th of April 25 been a remittance-based user, but this is not restricted to someone that has made a claim for the remittance basis, so that's quite important to note. And it is possible to access even if they have subsequently become deemed domiciled in the UK or even acquired a UK domicile of choice. And how will it work? So there will be two rates. The first is 12% and the second is 15%. This is a slight improvement in terms of the number of years that the regime will be available, and the claims are made via the tax return, and essentially there is a 1 year anniversary after the filing deadline by which the claim must be made. In terms of how it will work in terms of in practice, an individual will need to designate an amount of unremitted foreign income and gains, and this will be known as qualifying overseas capital. So essentially, an individual from 6th of April 25 would designate a pool of foreign income and gains and pay the TRF. However, the significant difference here is that they can remit those funds in the TRF window. By the TRF window, I mean the sort of 3 years from April 25 to April 28, or they can choose to remit it later. And where I think this will be really useful is for those individuals that might have funds that are in jurisdictions subject to capital controls. So that's quite attractive. What is a little bit disappointing, though, is that there will be no foreign tax credit relief against the TRF amount. That being said, though, it will be the 12% or the 15% on the net amount, being net of foreign tax suffered in an overseas jurisdiction. In terms of what will qualify as being designated, I think, again, there is some opportunity here because actually it won't be restricted to just cash. Assets can also be nominated or designated, sorry. So if I were to designate the foreign income that was previously unremitted, that was used to purchase an asset, then those subsequently, if that asset was sold, those funds could be transferred to the UK free of further tax in terms of the previous unremitted foreign income. In terms of other sort of benefits around this TRF, and this is something that's a little bit different to any transitional relief we've seen previously, there is this opportunity where it's difficult to ascertain what the composition of an account is, or an individual no longer has records relating to how an asset was funded, to designate these types of accounts or assets and also transfer to the UK, benefiting from the TRF. The one sort of hesitation here is that, of course, where it's not known how much foreign income and gains contributed to the purchase of an asset, it's quite likely that there was some clean capital there as well. And so in practice, it's probably going to be worthwhile for individuals to have advisors reevaluate and prepare a composition of that account. But where that's not sort of feasible, then this opportunity does exist. And last but not least, there is this quite nice change to the ordering rules, such that if an individual has a mixed fund and does designate an amount of unremitted foreign income, then when transferring from that account to the UK, that designated amount will come to the top of the ordering rules for matching that transfer, which is quite attractive. In terms of the other sort of leg of the temporary repatriation facility, it's very much with respect to post-April 25 trust distributions. Now, it will be possible to designate a capital distribution that is matched to pre-April 25 relevant income and trust gains. We will need to take some care around this, and quite proactive planning will be required here, but this is quite welcome as this is something that was not sort of anticipated from the spring budget time. So this is going to be something that I think Sean will also touch on. The last leg of the transitional reliefs is with respect to rebasing. Now, who can benefit? It's taxpayers who have claimed the remittance basis between 2017-18 and 2024-25, at least once. and have not been deemed domiciled or actually domiciled in the UK for income tax or capital gains tax purposes in any tax year up to 24-25. So slightly different conditions to the TRF. In terms of this relief, it's not subject to a claim, it is actually automatic. But if an individual finds that it's not advantageous, then they can disapply it on an asset-by-asset basis. So where this will be quite useful from a planning perspective is combining the TRF and rebasing. So for instance, if an individual had unlimited foreign income that was used to purchase single line equities, they designate the foreign income used to make that purchase, they rebase the single line equities to April 17 value, post April 25 they sell those equities, then yes, the gain from 17 to 25 will become taxable in its usual way, but the historic income used to purchase the equities will not give rise to further taxation when the funds or the proceeds of sale are transferred to the UK. So I think there's going to be some opportunities around that, particularly as it relates to assets that are held. Over to you, Sean. Thank you.
Great, thank you for that, Heather. And lots to, and I think Heather was quite right when she pointed out that a lot of this is going to be about pre-planning and making sure you get the timings of certain transactions right, in particular for individuals who are still capable of claiming the remittance basis this year, and whether or not you want to realise some gains under the remittance basis and or income under the remittance basis and then take advantage of the temporary repatriation facility to bring back funds at a particularly low or attractive rate of taxation in the first 3 years. So there's going to be a lot of issues for clients that those. There's also some interesting points around the temporary repatriation facility and qualifying overseas capital and the account structuring that's required and would be useful from a banking perspective. So again, there'll be some work there for clients. And of course, as we step away from the remittance basis of taxation, there will be general account restructuring required to reflect the new rules. So for those who have portfolios of traded securities overseas, and previously established clean capital structuring and or structuring to facilitate and take advantage of the remittance basis, work will need to be done this year in order to firstly practically restructure for the new regime, and then secondarily see if there's anything that can be done to maximise the outcomes under the temporary repatriation facility, which looks incredibly attractive for those who are planning to stay in the UK for a reasonable length of time post the end of the remittance basis being applicable to their circumstances. So, as Hetal said, I'm going to talk specifically about the taxation of settlements. We thought it'd be useful to do this in the format of a worked example. So what I'm going to do is I'm going to outline the scenario, and then we're going to talk with some detail about how one would approach analysing the client's position or the individual's position, and then things that need to be thought of. I am just going to note this is a little bit complicated as an area, and so there will be some questions that will come away from this. We have decided that perhaps the best thing to do will be to respond to any questions separately post the event. So if you do have questions, please do put them in the Q&A function on Zoom, or alternatively send us an email and we'll be happy to follow up on those on an individual basis. And if we have similar questions on the same theme, we may do some frequently asked questions coming out of the seminar. So without further ado, we have an individual who's UK resident. He's a historic remittance basis user. He established an overseas discretionary trust on or around the 30th of March 2017 for the benefit of himself and his immediate family, so spouse and children. He did not add any additional assets to the settlement post 5th of April 2017. The trustees, on receiving the settlement, which was a settlement of cash, used those funds to establish an offshore company, JCO, that then held those funds and invested in a portfolio of traded securities. The trustees funded that company by way of loan and share capital, so small share capital, so £100, and the rest of the funds being designated as loan, a shareholder loan into that entity. Our individual is capable of claiming the remittance basis in 24-25, but will not be a recent arriver from 25-26, so he's incapable of claiming the new regime for foreign income and gains, and it will be their 11th year of continuous residence as of 6th of April 2025, so will become subject to inheritance tax. What we're going to be thinking about is what is their position post 6th of April 2025, and as a result of that, what they should be thinking about. Now, we're going to come on to what I think are the first part of the exercise that one would need to consider when establishing what options the client has, and also what the impact of the new legislation will be. And I'm sort of referring to this as a foundational analysis, which is incredibly buzzy and exciting wording. But it's basically doing an exercise to understand what the current anti-avoidance regime applicable to the settlement will be, and what the position will be as of the 6th of April 2025. It is important to note that the anti-avoidance legislation that applies to offshore settlements, being for income tax, transfer of assets abroad, and the settlements legislation, and for CGT, Section 86 and Section 87, with some interaction with Section 3, have broadly remained the same, though with some modifications to, in effect, remove the protected trust regime that was in place from April 2017. For those who don't actively advise clients who had protected trusts, broadly from April 2017, there was no attribution of foreign income and gains within the settlement to the settlor, even if they were capable of benefiting from the trust, which was incredibly attractive. And proved to be a panacea to some of the changes that we saw in April 2017 when we had the introduction of the 15 out of 20-year rule. So we've seen an end of the protected trust regime and a reversion to the pre-2017 rules. Absent our ability to claim the remittance basis, that was incredibly important for avoiding a charge to tax on the income that arose to the settlement, and a loss of the domicile protections that were in place for Section 86 TCGA. So let's talk about how, though that anti-avoidance legislation is now likely to apply to most overseas trusts in the scenario that we discussed. So firstly, we've got the settlements legislation, important, but in the scenario that we're discussing, we're principally going to be concerned about the transfer of assets abroad legislation. So in this scenario, as income arise, if there was a tax avoidance motive, and any tax avoidance motive in establishing the structure that we've outlined, and I think, given it was a pre-2017 structure, you could perhaps suggest that there may have been some tax avoidance motive at the time that it was established, because there was there was potentially an IHT advantage, and also there was an income tax advantage that arose as a result of setting up the settlement. You would have a situation where the income of the underlying company and any income arising at trust level would be attributable to the settlor on an arising basis. So even though the settlor hasn't received any benefit from the trust because he is capable of benefiting from it, or indeed his spouse is capable of benefiting from it, he will be subject to tax as that income arises within the structure. That requirement to bounty is important. There will be a number of clients who will be looking to potentially exclude themselves from benefit in order to avoid a charge to tax on the transfer of assets abroad. It is important to note that in order to do that, the settlor and their spouse would need to be irrevocably excluded from the settlement. And that requires a review of any trust deeds, and also to ensure that irrevocable exclusion is effective, even if successor settlements or sub-funds were created within those structures. So there is some complexity to actually just simply excluding oneself. A revocable exclusion won't work. So the potential for bounty will be enough, even if it hasn't happened. The CGT attribution position is slightly more complicated and unfortunately pretty unattractive. So, because you have less options in relation to excluding oneself from benefit. So, because the settlor can benefit, his spouse can benefit, we will be within Section 86. Even if the settlor and their spouse could not benefit, if their children or grandchildren were capable of benefiting, the settlor, if UK resident, would still be subject to attribution under Section 86 for any trust gains. So that's gains made by the trustee that have arisen will be attributed on a rising basis to the settlor, even if that settlor is incapable of benefiting. So we have a very broad class of defined persons, in addition to children, grandchildren, spouses. Also, if you have a connected company that can benefit, that will also be within those provisions. So that's how Section 86 works in this scenario. As we discussed, and moving back to our slide, you will note that we've got an offshore company interposed between the trust and the portfolio of traded securities. That's particularly interesting for deciding on how much of the gains arising from the structure will be attributable to the settlor. There is a different test that applies. So Section 86 does not have a test. There's no motive analysis that applies. But for Section 3, for the company, there is a motive test, and there had to be a CGT or corporation tax avoidance motive at the time that the company was established, in order for the gains of the company to be attributed to the trust, allowing them for them to be matched to under Section 86 to the settlor. We are talking to a number of clients at the moment about this particular issue. It was typical that those companies were not set up with corporation tax or capital gains tax avoidance motives because they weren't required to do that. The trust itself achieved those aims, but they were established for inheritance tax avoidance motives, which would not necessarily mean that you would be within the scope of Section 3. So for a number of our clients, we have the situation where we will have attribution of income throughout the structure, but we will only have attribution of gains that arise directly to the trustees. And so if you have an intermediated holding company between the assets of the trust and the trustees, it is not necessarily the case that the trust will become, for want of a better way of expressing it, transparent for the purposes of capital gains tax. So some settlements will still remain attractive for CGT. And if you have single line or illiquid tax positions, that might be attractive, and a reason for retaining the structure for its CGT protections alone. So there's quite a lot of work to be done for clients who've got that scenario. So again, flicking back to our earlier slide, as it stands from 6th of April 2025, we're pretty much of the view that the UK resident settlor beneficiary is going to be subject to tax on the income as it rises, unless he excludes himself and his spouse from benefit. Any gains that arise to the trust will be immediately attributable, but there's no reason why on a day-to-day basis you would see gains arising to the trust, and they're most typically going to arise at the time that you liquidate or distribute out the offshore company itself. And potentially will be subject to attribution in relation to the portfolio of traded securities. I think given the timing of when this settlement was set up and subject to the advice that was received at the time and any contemporaneous information that's on the file, it may not be the case that it was a UK tax or capital gains tax or corporation tax avoidance motive in setting up the offshore company. And so it may be the case that the capital gains are blocked out from being subject to taxation. So potentially a slightly better position than one would have assumed when looking at the surface of the legislation that's now going to be introduced. That's our initial position. Obviously, and not related to the slide we're discussing, but non-UK resident settlors, but where you've got UK resident beneficiaries. So you've got a non-UK resident, non-resident, non-dom that establish a structure for the benefit of UK resident beneficiaries, will not be affected by this change in rules, and the old rules will continue to apply, i.e. that they can receive benefits from the trust and they'll be subject to tax. If those individuals are capable of being within their first 4 years of tax residence, they may be able to receive distributions, and it may well be worth looking at accelerating distributions to fund UK lifestyle in the period, in the first 4 year period, also noting that those assets remain outside of the UK, they're not subject to inheritance tax for those 10 years. So there will be some planning for non-resident, non-dom established trusts where there is a class or a group of UK resident beneficiaries, and mapping out how best to take assets out of that structure in light of the 4 year rule and the 10 year rule for inheritance tax. It would be remiss of me to not point out that And this has always been the case. But for individuals that establish trusts while they were non-resident, non-dom with no UK tax avoidance motive, so legacy structures, they may not be affected by the they might not be affected by much of the anti-avoidance that applies in this situation. So you do have to take a step back and also think about, well, if this structure was established 10 years before arriving in the UK, am I subject to the same anti-avoidance framework? And do I have, for want of a better way of expressing it, a golden trust where even if I receive capital distributions, it's unlikely that I'm going to have a tax charge coming from the structure. So again, a good opportunity to refresh the analysis. For some clients who are benefiting from the protected trust regime, there was perhaps a view from advisors that you didn't have to do much of the historic review, you just accepted it was in the protected trust regime. But now I think that perhaps more detailed analysis is required to establish how the anti-avoidance legislation is going to apply to your structure. And again, as Helen and Lara discussed, recent arrivals will also have, if they come to the UK with a trust, will also have to give some considerations as to whether they want to restructure it in advance of the 4-year period elapsing whilst the regime that is advantageous for them on foreign income gains is available. So, once we've done that exercise, we understand how that structure is going to be taxed as of the 6th of April 2025 and what the position is going to be for the settlor. So now I'm thinking about what steps do I want to be taking in advance of the 6th of April 2025 to mitigate or ameliorate some of what could be perceived to be disadvantages of the new regime as applied to that arrangement. So the first thing you have to do is have a look at the historic position of that trust and establish what the income and gains profile is, and then apply your anti-avoidance analysis to say, well, that's what's going to be attributed to my settlor on an annual basis. So this is going to be my live tax cost for running the structure on a day-to-day basis. So that's an exercise that we're doing for a number of clients. It's not an easy exercise. In the situation that we had previously with our client, we've got a few years worth of data that are available to us. So we established a trust in just before 2017-18 tax year. So we can look at that profile, and an exercise to be done with the wealth managers to understand what the UK tax position would be for the settlor if they were treated as receiving the income directly. There is some modifications to the way that you do the calculations. So there is an overlay that needs to be done by a tax advisor or lawyer to have a look at the amount that actually would be attributable and the way that foreign tax credits will work in that situation, because you won't generally get the benefit of a foreign tax credit where it arose to an overseas settlement. And so there can be some disadvantages in relation to that. But then, so basically what we've done at that point is we've established how the trust is going to work going forward, and we know what the tax cost is going to be from a foreign income and gains perspective at that juncture. The next question we have to ask ourselves is, how are we going to fund that tax? Because that tax is being attributed to me and I haven't necessarily received a benefit from the structure. Again, just to take a step back, there's going to be a lot of work around matching a rising income and a rising gains within structures to distributions out in the same year. But for both income tax and CGT, there were previously, under both the settlements legislation and also under Section 86, a statutory right of recovery of the tax, where it was attributed to you from an overseas entity. So that was always that, and not treating those as distributions. So there's no double layer of taxation. So the settlements for income attributed to me under the settlements legislation, or capital gains that they're attributed to me under Section 86, I could always recover the tax. The transfer of assets abroad rules have been modified to also allow for that same recovery of tax. So there should not be a double layer of taxation funding that tax payment, because if you aren't going to take a distribution in the same year, you can have the trust fund that tax You will have to review the trust deed and discuss it with your trustees as to whether or not they're capable of funding that tax under the terms of the deed. But from a UK statutory perspective, relief is available. So there isn't a double layer of taxation in funding the tax itself. So we've looked at the tax profile of the trust. We understand how we're going to fund our tax payments. We're now thinking about, well, perhaps the tax analysis isn't as attractive as we would like it to be. We haven't previously been thinking about the UK tax environment in a material way as related to the suitability of the investments inside the structure. So for some clients, again, those clients who are going to retain the structure, switching from an income generating portfolio to a capital gains generating portfolio is generally going to be attractive. Obviously, if you have the Section 3 motive defence in place, that becomes even more attractive because potentially you aren't subject to the attribution of gains. So if you go into a gains-orientated environment, that will be attractive for you. And so keeping your income low and keeping your gain and taking most of your returns as gains will be potentially the right profile for a number of clients. Individuals who hold non-reporting funds, and just to explain what non-reporting funds are, or trusts holding non-reporting funds are collective investment schemes situated outside of the UK, so offshore funds under the FSMA definitions, that will realise gains. If you're a non-reporting fund, you are generally subject to income tax on that gain. There are a number of clients and advisors that took the position that if non-reporting fund gains, so offshore income gains, arose to a trust, it wasn't subject to attribution. HMRC have not been of that view. We actually are seeing some inquiries on this particular issue, where individuals made claims on their tax return that they disagreed with the Revenue's opinion that non-reporting fund gains weren't subject to attribution. The position is now clear. You're subject to attribution. That does remove some of the uncertainty. Strangely, non-reporting funds for individuals who are thinking of exiting the UK in a defined timeline might be quite attractive. So let's take the position where we're thinking of exiting the UK in another 4 or 5 years. We've got an overseas trust. We are restructuring in advance of 2025. We could potentially go into a non-reporting fund with the majority of our assets, or all of our assets, invest in those units, and just so long as we don't redeem any of those units in the period of UK residence, there's no taxation because there's no reportable income for a non-reporting fund, and therefore there's no tax to pay. So strangely, for some clients, non-reporting funds are going to become of interest again. But broadly, you're going to be talking to your wealth managers and wealth advisors about how do I deal with the portfolio, and strangely going into a more UK domicile orientated portfolio structure. So the sort of portfolios that we see for a number of our clients, which again, capital gains tax heavy and income low. Heather talked about the rebasing position. There is no rebasing for trust assets to the 2017 values. It's only assets that you hold personally. There was rebasing in 2008. There was a significant rebasing opportunity. There is some interaction with those trusts that did do a rebasing election at that time. So again, some deep research to be done and some workings to be done on that. But the transitional rules for 2008 rebasing are quite attractive. So one to look out for there. And again, just remembering the Section 3 analysis. If you're taking steps with a CGT avoidance motive, you may lose your Section 3 defences. So you've got to give some very strong consideration to the steps that you're taking pre-6th of April 2025 and retaining those defences. I don't think that portfolio reconstruction would qualify as an avoidance. I think it's just mitigation for the purposes of Section 3. So I still think you can do rebasing exercises. So yeah, just on that rebasing point, for clients who are going to be subject to tax, capital gains tax on the assets within the trust, there's almost certainly going to be a reason in 24-25 to look at rebasing those assets to their market value, to their current market value, to wash out legacy gains. be very cautious. We do have bed and breakfasting rules, and those bed and breakfasting rules will still apply. So you're going to need a 30-day period before reinvesting in the same assets. So some work to be done there. It's now the midpoint of November. It is definitely time to have a chat with the wealth managers and for trustees and directors to have a chat with the wealth managers about how best to rebase where it is relevant. That's the broad position. That's what we're talking to our clients about before 6th of April 2025. Again, coming back to our client scenario, we've now started to, we do understand how the trust is going to work. We're now taking steps to ameliorate the disadvantages or mitigate the disadvantages in relation to the portfolio of traded securities underneath. And so what else can we be thinking about? The next thing that we can be thinking about is the temporary repatriation facility. Now, fortunately, in our client scenario, we set the trust up just before the protected trust regime took place, which has meant that inside the trust, there is income and potentially capital gains that have been unattributed. So because under the protected trust rules, there was no taxation until you received a benefit from the trust, in most circumstances, we have a stockpile of income and gains that would match themselves to a future capital distribution from the trust. And again, that's about 8 years worth in this scenario. So we've potentially got a reasonably valuable stockpile there. We can, from 25-26, designate an amount of that unattributed foreign income and gains to a future capital distribution. And though my reading is that has to be done at the same time. So you have to make the designation and receive the capital distribution at the same time to ensure that the matching works, because you can't do that over 2 or 3 years. So you couldn't do a designation in the first year and then receive the benefit in the third year. I think you have to line those up, because otherwise the matching rules won't work. I think this very much seems to be the case from the technical note that that's how that works. You'll have to make a designation to the unattributed FIG and then take a capital distribution in the same year. And that will then qualify for the 12%, 12% or 15% rates of tax. Again, looking at our situation with our client, who's a remittance basis user, he will also have to overlay the fact that he may want to take some distributions out of the trust under the remittance basis in this current tax year. The TRF only applies to capital distribution, does not apply to income distributions. There may be some limited circumstances where a income distribution under the remittance basis, followed by capital distributions under the temporary repatriation facility, makes sense. And so there'll be some issues there. Again, as it relates to the point that Hedful was talking about regarding amounts where it's difficult to define, it may be the case that you want to just take those out as income in the earlier period. So some work to be done there. A lot of planning is going to be around this unattributed foreign income and gains point and the temporary repatriation facility. As some of you may or may not be aware, there was some additional legislation brought in around 2017 around onward gifting and also close family member provisions, basically deeming provisions. The onward gifting rules were designed to stop individuals receiving benefits while they were either non-resident or non-domiciled, and then forward gifting them onto an individual who is UK resident, and that UK resident not being subject to taxation. The close family member rules were in relation to close family members situated outside the UK, generally or non-domiciled, receiving benefits if they're a minor child or spouse, and attributing that back to the settlor. There've been a reasonably complicated set of rules. The close family member provisions aren't too bad, but the onward gifting rules in practice have some issues with them and have been modified accordingly. But it would appear that the temporary repatriation facility and a designation of the temporary repatriation facility should solve your onward gifting problems. From a tax perspective, I do think there is some sequencing just to make sure that you're comfortable with that, and some work that will need to be done there. I have plenty of clients that are thinking of distributing assets out for the benefit of the next generation, so significant capital coming out and doing that in potentially a period similar to the period that we have with our client, of receiving benefit from the trust this year and then making an onward gift with a view to benefiting from the current inheritance tax regime that applies in their scenario. So there'll be a lot, it's multifaceted when you're looking at these questions, because you're potentially balancing both the inheritance tax analysis with the foreign income and gain analysis and our anti-avoidance provisions with a view to finding an optimal outcome. And that will be much of the discussions that we'll be having over the course of the next 4.5 months. The temporary repatriation facility does a lot to mitigate some of the downside of the new regime and gives us the ability to access some of the capital comprised within our trust. For those who decided that they wish to continue to retain the trust, of which there will be a number, and I'll come on to the inheritance tax analysis shortly, one of the ways to mitigate the active taxation on the portfolio assets will be to look at something like an offshore bond. So an offshore bond, as Lara mentioned, is an overseas life insurance policy or capital redemption contract situated outside of the UK. Those bonds are subject to a specific tax regime known as a chargeable event gain regime. It's always been excluded from the remittance basis, but the advantage of it is the foreign income and gains are treated as arising to the life office that established the offshore bond and are not attributable to the investor, being the trustees, and therefore not attributable to the settlor, who's based in the UK. So an offshore bond product would very much block out the foreign income and gains. It also gives you the ability to then potentially take out the 5% on an annual basis without triggering a potentially attributable charge to tax under the chargeable event gain regime. In fact, it's worth noting that it's not attributable, it's actually directly chargeable on what is referred to as the creator under these rules. But you will have, some clients will be looking at offshore bonds. Again, some clients will be looking at offshore bonds post and potentially the combination with doing some work around the temporary repatriation facility to potentially wash out some of the foreign income and gains that have already accrued to the structure, and then investing in an offshore bond in what could be best referred to as clean capital, although the words clean capital are going to come up less in taxation going forward. But there will be some advantages there for clients who are looking at offshore bonds. I would note that there are significant investment limitations if you want to have control over, or the trustees want to have control over the offshore bond decision making for the portfolio of traded securities, or you'll have to have a discretionary fund mandate underneath the offshore bond. Otherwise, you're subject to the personal portfolio bond regulation. So there's quite a lot of limitations with offshore bonds, and of course, there's an additional layer of cost, but very much for those who want to retain their trusts, a reasonably simple way of approaching the problem, dealing with it. I mentioned earlier that offshore funds will potentially become more attractive, both reporting and non-reporting classes. The positive thing about reporting classes is we'll get CGT treatment. Coming back to our Section 3 analysis, that might be super attractive. Even without the Section 3 analysis, reporting fund is still attractive because when I dispose or redeem my units, I'm only subject to capital gains tax. I'm not subject to any income tax. The reporting fund will have annual income that it has to report, and that will be attributed to the settlor. But broadly, because these are generally established for the UK market's perspective, i.e. being reporting, it is the case that most of those funds try to keep the income relatively or very low that would be attributable in the structure to you. And for those clients who are looking to stay in the UK in the long term, a more simple solution and perhaps offering a wider investment universe, we'll be looking at non-reporting funds and simply holding the funds in non-reporting funds with a view to an exit at a later date and not being too concerned about the offshore income gain regime. So there's some advantages there. Lastly, and it would warrant in of itself an entire webinar, we have private label funds and structured products. There are definitely going to be some clients, in particular those who have investables above 25 million US, that will look at private label funds and structured products as an opportunity to act as a more sophisticated form of blocker, so a more sophisticated form of the offshore bond, to prevent the attribution of gains, certainly, and there will be some good arguments about the ability to block out income and the disapplication of the transfer of assets abroad regime and the regime that's applicable to collective investment schemes. So there's some good stuff there, but pretty high level planning for most clients, and again, a subject of a separate seminar if we want to do one. So our client has done quite a lot of thinking already. They've structured their assets with a view to the 2025-26 foreign income and gains regime. They've thought about how much they might want to take out of the structure from a temporary repatriation facility perspective. That position is as resolved as it can be. So all very positive. We're now going to move on to the taxation of settlements, inheritance and inheritance tax. Lara very eloquently introduced the concept of the long-term resident, so an individual that's been resident for more than 10 out of the last 20 tax years. This has a significant impact on overseas trusts. If we have a long-term resident settlor who had previously established an excluded property trust, so again, coming back to our individual, this individual was non-domiciled when he established his trust. We're assuming that he established it with an offshore cash, so not situated in the UK. So when he established this trust, it was an excluded property trust for inheritance tax, which meant that the assets were outside of tax in perpetuity for the individual who settled them onto the trust, and also the trustees were not subject to the relevant property regime, i.e. the decennial or 10-year anniversary and exit charges. That position changes as of 6th of April 2025. If the individual remains in the UK, he will become a long-term resident and he will be subject, the trustees will then become subject to the relevant property regime, which means on the 10-year anniversary of the trust, so in this case, 2027, the trust will be subject to a charge based on the value of the trust assets. The calculation is complicated, so I won't go into it, but a maximum charge of 6% can arise on the trust assets at the time of the decennial charge. And when assets leave the trust, or capital leaves the trust, sorry, if income leaves the trust, there will be no exit charge, but if capital leaves the trust, you'll have an exit charge on a prorated basis up to, again, a maximum of 6%. The way that that's calculated is with reference to the difference between the decennial charges. So if distributed 5 years after a decennial charge, the maximum rate will broadly be 3% on the exit charge. There is a form of time apportionment relief. The individual will be, the period when the assets formed excluded property will reduce the amount that's subject to the charge. So for our individual here, our decennial charge will only be calculated on 2 to 3 years of holding relevant property, and the 7-year period beforehand will be excluded from the charge to tax, which is positive, and will help mitigate some of the material disadvantages. One of the other issues that will arise in this new regime, where you had a UK domiciled settlor who is no longer resident in the UK and ceases to be long-term resident from 6th of April 2025. So again, that's in the situation where you've got your expatriate who's moved to Hong Kong but has set up a UK trust when he was domiciled here. That trust will cease to be within the scope of the relevant property regime, and an exit charge based on the value of the property will be crystallised. So there's some issues there that one would need to give some thought to, and I think one of the practical problems here is, from an administrative perspective, identifying those clients that will be subject to a change in their long-term residency position. I think it's more obvious where you've got UK resident settlors, and it's going to be relatively easy to identify where this might be a problem. For individuals who settle trust when they're UK domiciled, actually, slightly more complicated questions. It may not be the case that the trustees know where they're currently resident, and often it was the case that these are more family trusts rather than professionally administered trusts. So issues there, I think, coming up. And again, it's important to know that you can come in and out of this long-term resident regime, and the implications are that when you exit the regime, you'll have an exit charge, is how that's going to work. The one important grandfathering provision that was introduced, and I think it's the reason why a lot of people will look to retain their settlements, and again, relevant to our client who established this trust in 2017 and established it with non-UK assets, a grandfathering provision has been brought in. That grandfathering provision means that for assets settled onto the trust by a non-domiciled individual prior to the 30th of October 2024, those assets will not be subject to tax in their estate if any assets have been contributed post 30th of October 2024, those assets will be within their estate. So there's a material change in the gift with reservation of benefit rules and the anti-avoidance around gift with reservation of benefit. So for our clients with pre-existing trusts, and again, in our situation that we just discussed, those assets that are contained within the trust, while subject to the relevant property trust regime for the trustees and subject to ongoing tax for the length of time that our client remains long-term resident, it is important to note that they will be outside of the estate in perpetuity, subject to not adding any assets to that settlement. So the trust is still acting as an inheritance tax shield in a partial form, which is incredibly attractive, especially given that you can still benefit from that trust. So that will be one of the major reasons why clients will look to retain their structure post 2025, is because of the IHT advantages that are offered by the structure for the assets that were contributed prior to the 30th of October. It may be difficult to replicate that, especially when we're talking about older clients who can't insure against some of that risk. We're having conversations with some clients about potentially exiting some of the capital from the structure, but retaining it and then insuring against the risk of some of it, or alternatively just passing it down to the next generation. And obviously noting that they won't be subject to the PET regime if they receive a distribution from the trust. There will be some conversations with the clients who are slightly older age profile or have health issues. It may be the case that insurance isn't a viable option, and the trust is then potentially providing a very attractive solution in the longer term to shield those amounts from inheritance tax. Obviously, the downside of that is any new trust will not be capable of benefiting in that same way. So if I establish a trust today, obviously you will have charges anyway if you're a long-term resident, but if I establish a trust today as a recent arrival to the UK, so not subject to the long-term resident rules, once I've had 10 years of tax residency, I will go within the relevant property regime and the assets will be back in my estate for IHT purposes. So that's going to be a question we're going to be wrestling with for a number of clients, and will form part of the decision matrix in taking things forward. And obviously there are some downsides, but it is important to note that the reliefs, so agricultural property relief and in particular business relief for inheritance tax, will still apply for the trustees. And so if there are trading companies inside the structures, it may be the case that whilst we come back into the regime, we've still got the benefit of business relief for inheritance tax, and we can still benefit from those reliefs, and those reliefs will be applicable to the decennial exit charges and also to the gift with reservation of benefit rules. So it may be the case that whilst the regime has changed, the actual tax analysis has remained relatively neutral. Although, of course, noting that we are in the process of changing our business relief rules over the course of the next couple of years, and the relief that's applicable will become less attractive. As mentioned at the start of this section, we unfortunately don't have time for Q&A, and we think some of the questions coming away from this might be quite complicated. So if you do have any questions, please do put them in the Zoom chat. Or, of course, you have our contact details on the slides. We'll be distributing the final version of the slides. I just noticed a typo, so post-event. And we're, of course, available on our emails and telephone numbers if you require anything from ourselves. So we'd like to thank you for taking the time this morning. I'd like to thank my fellow speakers, Lara and Hettel. And we wish you a pleasant rest of the day. Thank you so much.
Thank you.